Good day everyone and Pauline Peace. Today we are going to tackle and learn all about another type of valuation method, which is the return on investment based business valuation method. But before we proceed to the content, we have 7 lesson objectives here, which by the end of the presentation, we are able to first know and be acquainted what return on investment as valuation method is. Second, to know the reasons in considering ROI as the valuation method. Third, discuss the use, purpose, and importance of ROI as valuation method in the business. Fourth, recognize the calculation process of ROI. Fifth, distinguish what a good ROI is. Sixth, be aware of the limitations of the ROI. And lastly, present an illustrative example of ROI-based business valuation method.
Hello and good evening. This is Montilla, and now we need to know what is return on investment based valuation method. Return on investment, or ROI, is a performance metric that is used to evaluate an investment's efficiency or profitability, as well as to compare the efficiency of several distinct investments. Usually, this metric is called benefit cost ratio, while the return of investment based valuation method evaluates the value of the invested money to determine and directly assess the benefit or return of an investment from the cost of the investment. It should be noted that in such cases, the results of the calculations have a different meaning. A high ROI, or above the average percentage of return on investment, means the investment's gains compare favorably to its cost. On the other hand, a low ROI, or below the average percentage of return on investment, implies the cost on investment is taking over than the investment's gains. Return on investment is not necessarily the same as profit. ROI deals with the money you invest in the company and the return you realize on that money based on the net profit of the business. Profit, on the other hand, measures the performance of the business. And now, let's talk about the reasons in choosing the ROI based valuation method. So, the first one is easy to understand and straightforward. Second, easy to compute. Third, encourages practical detailed financial analysis. Fourth, it provides quantifiable evidence of value. Fifth, encourages cost efficiency and focus on one of the main corporate metrics, which is profitability. Sixth, data used is available in the accounting system or official documentation, which provides objective outputs. Lastly, it provides a rationale for future investments and acquisition decisions.
Good evening, everyone. This is Mitch Minglana. My part is to discuss on how the return on investment is used, its importance and purpose as the valuation method in businesses or to the investors who wanted to assess, evaluate, or to measure the probability of gaining a return from an investment. First and foremost, the return on investment deals with the money you invest in the company and the return you realize on that money based on the net profit of the business. To avoid confusion, before I begin the main point of my discussions, I'll just give a brief difference between the return on assets, return on equities, and return on investments. I know we are very familiar with this, but I just like to add this topic to have more understanding. So, return on assets is used as an indicator of how profitable a company is relative to its total assets. It gives the investors, managers of the business, or even the analyst an idea as to how efficient a company's management is at using its assets to generate earnings. So in short, return on assets tells us about how effectively a company is taking earnings advantage of its assets. On the other hand, return on equity, this has something to do with the shareholders' capital or investments, right? So ROE tells us how effectively an organization is taking advantage of its base of equity or capital. Return on equity is generally the net income divided by equity, while the return on assets is the net income divided by the average assets. So there you have it. Let's move on to return on investments. ROI may be used by regular investors to evaluate their portfolios, or it can be also applied to assess almost any type of expenditure in the company. So in the viewpoint of the investors, ROI is presented by subtracting the initial value of the investment from the final value of the investment, which equals the net return. Then dividing this new number by the cost of the investment, and finally multiplying it by 100. So to understand this, let's illustrate an example. Assume an investor bought 1,000 shares of the hypothetical company Worldwide Wicked Co. at 10 peso per share. 1 year later, the investor sold the shares for 12.50 pesos. The investor earned dividends of 500 over the 1 year holding period. The investor also spent a total of 125 peso on trading commissions in order to buy and sell the shares. So the ROI for this can be calculated as follows. To calculate the net returns, and total costs must be considered. Total returns for a stock result from capital gains and dividends. Total costs would include the initial purchase price as well as the commissions paid. So in the calculation of the ROI for this problem, the gross capital gain before commissions from this trade is 12.50 minus 10 times 1,000. And then the 500 amount refers to the dividends received by holding the stock, while 125 is the total commissions paid. If you further dissect the ROI into its component parts, it is revealed that 23.75% came from the capital gains and 5% came from the dividends. So the total ROI for this particular problem is 28.75%. On the other hand, ROI can also be applied to assess almost any type of expenditure. For example, your business invests in a complete redesign of your website. The total cost of investment is 15,000, which includes a custom e-commerce website design and quality photos of your entire product line. After the first month, your new e-commerce store generates a net profit of 3,000. This net profit is calculated after deducting monthly website hosting fees, product shipping and handling costs, and additional costs associated with your new e-commerce store. So to calculate the ROI for this problem, all you have to do is to get the net profit divided by the cost of initial investment times 100. So the ROI of the website redesign for the first month alone is 3,000 divided by 15,000 times 100, resulting to 20% of return on investments. So just keep in mind that ROI is only as good as the numbers you feed into your calculation. The ROI cannot eliminate risk or uncertainty. When you use the ROI to decide on future investments, you still need to factor in the risk that your projections of net profits can be too optimistic or even too pessimistic. And as with all investments, historical performance is no guarantee of future success. Purpose of return on investments. The purpose of the return on investment metric is to measure per period rates of return on money invested in an economic entity in order to decide whether or not to undertake an investment. Importance of return on investments. The primary reason why people invest in a business is to make money. Return on investment is a measurement of efficiency in converting your business investment into profit. Therefore, it is vital to projecting whether a business venture is worthwhile and what adjustments to make once a company is active. So that's all for my part.
Good day and Pauline peace. This is Beth Millora, and my part is to discuss about how to calculate return on investment. So let's start. Return on investment tells you how much money your money earned. And to calculate it, divide the amount you earned from an investment often called as the net profit, or the cost of the investment minus its present value, by the cost of the investment and multiply that by 100. Take note that the result should be represented as a percentage. To easily understand how to calculate ROI, here are the two ways or the formulas to get the return on investment. First, ROI is equals to net profit divided by the cost of investment multiplied by 100. The second one, ROI is equals to present value minus cost of investment divided by cost of investment multiplied by 100. To elaborate the ways given, here are some examples. Example number 1, using the first formula. Mitch bought a used car for $1,200. After 6 months, she decided to sell the car for $1,800. Here's how Mitch would calculate her ROI. Given the first formula, ROI is equals to net profit divided by the cost of investment multiplied by 100. In the given example, Mitch bought the car for only $1,200 and sold it for the amount of $1,800. Therefore, her net profit is $600 divided by 1,200 cost of investment multiplied by 100. Mitch's ROI is equals to 50%. Our second example still used the first formula, which is ROI is equals to net profit divided by cost of investment times 100. Bambs invested $2,000 in stock. 1 year later, he sold the stock for $2,500. So Bamb's net profit was $500. Here's how he would calculate his ROI. ROI is equals to $500 or the net profit divided by the cost of investment amounted to $2,000 multiplied by 100. Therefore, Bamb's return on investment is equals to 25%. For our last example, we use the second formula. Let's say Betty invested $5,000 in Piggy's company last year and sold her shares for $5,500 this week. Here's how Betty would calculate her ROI for this investment. Given the second formula, ROI is equals to present value minus cost of investment divided by cost of investment multiplied by 100. Therefore, ROI is equals to 5,500, which is the present value, minus the cost of investment amounted to $5,000 divided by $5,000 multiplied by 100. Betty's return on investment is equals to 10%. That's all for my part, and the next part will be reported by Miss Bonite. Thank you.
Good day, everyone, and Pauline Peace. This is Stephani, Cris, Bonite, and in my part is to discuss what is a good return on investment. You have one goal when you invest, to make money, and every investor wants to make as much money as possible. That's why you will want to have at least a general idea of what kind of return you might get before you invest in anything. Return on investment is expressed as a percentage and is extremely useful in evaluating individual investments or competing investment opportunities. But the question is, what is a good return on investment? It should be noted that a positive return on investment means that net returns are positive because total returns are greater than any associated cost. A negative return on investment indicates that net returns are negative. Total costs are greater than returns. On average manner, business owners usually have to take more risk Most business experts advise buyers of typical businesses to look for an return on investment between 15 and 30%. In restaurant industry, in general, the average annual return on investment is between 15 to 25%. According to conventional wisdom, an annual return on investment of approximately 7% of greater is considered a good return on investment for an investment in stocks. The most important consideration in determining a good return on investment is your financial need. What qualifies as a good return on investment will depend on factors such as the risk tolerance of the investor and the time required for the investment to generate a return. All else being equal, investors who are more risk-averse will likely accept lower return on investments in exchange for taking less risk. Likewise, investors who are willing and to engage and take risk positively in return may receive higher return on investment. Another thing, it depends on the type of industry. That's all for the what is a good return on investment. Thank you and God bless.
Limitations of return on investment. While the ratio is often very useful, there are also some limitations to the return on investment formula that are important to know. Below are the two key points that are worthy of note. Number 1. The return on investment formula disregards the factor of time. A higher ROI number does not always mean a better investment option. For example, two investments have the same ROI of 50%. However, the first investment is completed in 3 years, while the second investment needs 5 years to produce the same yield. The same ROI of both investments blurred the bigger picture, but when the factor of time was added, the investor easily sees the better option. Number 2. The return on investment formula is susceptible to manipulation. By changing accounting policies, treatment of certain items as revenue or capital, sometimes manager may reduce the investment base by scrapping old machines that still earn a positive return but less than others. Thus, the practice of abandoning old machines that are still serviceable may be used by managers to increase their return on investment. The annualized return on investment calculation provides a solution for one of the key limitations of the basic ROI calculation. The basic ROI calculation does not take into account the length of time that an investment is held, also referred to as the holding period. The formula for calculating annualized ROI is as follows. So that is the formula of annualized ROI, where N is equal to number of years for which the investment is held.
Good day again and Pauline Peace, this is Bambie. After listening from all the discussions a while ago, we are now ready for the illustrative problems that we set about the ROI-based business valuation method. And I am the one who will show that to you at the same time, calculate it with you as part of our presentation. In this presentation, we have prepared two problems with different scenarios. Let's start with the problem 1, engaging to a business. Andrea, Beth, and Jewel are friends. They are planning to establish a grilling restaurant called Hang Grill by the Beach. However, they are not certain if the money they will capitalize is worthwhile so as if the project will foster. Hence, in order to know the feasibility of the project's success, they made a projection for their cost of investment and income statement. So the questions are, what is the return on investment or ROI of the business? And based on the ROI result, Is it a good decision to continue the project? But before we proceed to the calculation process, it is noticeable in the problem that the scenario is only composed of getting the ROI for 1 year for one business investment. So we have already here the total business cost of the said business, which the particulars are divided into two, the fixed assets and the working capital. Under the fixed assets, we have the grilling resto amounting to 50,000, furniture and fixtures amounting to 75,350, cooking tools and equipment amounting to 4,870, with a subtotal of 130,220. And under working capital, we have here the raw materials, 9,484, overhead amounting to 8,400, and the selling and administrative amounting to 33,260 and 4 centavo, with a subtotal of 42,608 and 4 centavo. Adding the total fixed assets and the working capital, it gives us the total project cost of 172,828 and 4 centavo. The total project cost or business cost in this problem is actually the total cost of investment. And for the projected income statement, we have here the sales amounting to 1,026,175 pesos, less the cost of sales of 602,651 and 50 centavo, which give us the result of gross profit amounting to 423,523 and 50 centavo, less the selling and administrative expenses 311,295 and 50 centavo, which give us the net profit of 112,228 pesos. As what we said earlier, some of the reasons to consider ROI as valuation method are because it's easy to calculate and the data used are available already in the official financial documentation, like the net profit and the total project cost, which provides us the objective outputs, and it provides a rationale for future investments. So to calculate the ROI, we're just going to use the formula of return on investment equals net profit divided by cost of investment times 100. Since it is already given the net profit and the cost of investment, we have just to substitute it, where the net profit is 112,228 and the cost of investment is 172,828 and 4 centavo. We're just going to divide that one and times 100. It gives us the result of 64.94%, which is the return on investment. Based on the result of ROI, 64.94% implies that the benefit or return exceeds the total cost. This is a good sign that the said business will foster. And now let's proceed to the problem 2. Which investment is better? Suppose Joe invested $1,000 in Slice Pizza Corporation in 2017 and sold the shares for a total of $1,200 1 year later. With this information, one could compare the investment in Slice Pizza with any other projects. So suppose Joe also invested $2,000 in Big Sale Stores Incorporated in 2014 and sold the shares for a total of $2,800 in 2017. So the questions are, what is the ROI of the first investment, what is the ROI of the second investment, and which investment is more efficient choice? As you notice, the scenario in problem 2 is much different from problem 1. In problem 2, we already considered the time factor as well as comparing the efficiency of several distinct investments, which we have 2 investments in this problem. The goal of the problem is to determine which investment is more efficient choice. In finding the ROI of the first investment, we have to take note first the given in the problem, which are the value after being sold amounting to $1,200 and the cost of investment of $1,000. To calculate the ROI, we are just going to use the formula of net profit divided by cost of investment times 100. To obtain the net profit, we only need to subtract the value after being sold and the cost of investment, which gives us the amount of $200. So, $200 divided by $1,000 times 100, the ROI of the first investment is 20%. In the second investment, the same process in the first investment. We have to take note first the given in the problem, which are the value after being sold amounting to $2,800 and the cost of investment of $2,000. To calculate the ROI, we're just going to use the formula of net profit divided by cost of investment times 100. To obtain again the net profit, we only need to subtract the value after being sold and the cost of investment, which gives us the amount of $800. So $800 divided by $2,000 times 100, the ROI of the second investment is 40%. Based on these results, we can say that the second investment is better than the first investment given that the ROI of the second investment is higher than the first investment. However, we cannot conclude that kind of statement. Why? Because the scenario of Joe reveals some limitations of using ROI, particularly when comparing investments. While the ROI of Joe's second investment was twice that of the first investment, the time between Joe's purchase and sale was 1 year for the first investment but 3 years for the second. As I said, we are now already considering the time factor and comparing the efficiency of two investments. Based on the given problem, it resulted that the ROI of 20% was obtained only for 1 year, while the ROI of 40% was obtained for 3 years. So, we need to apply the annualized ROI formula to know the annual ROI of the second investment. Using the formula of 1 plus net profit divided by cost of investment raised to the power of 1 divided by n, where n is the number of years for which the investment is held, minus 1 times 100. We're just going to substitute everything until we came up to the result of 11.87% as the annualized ROI. Joe adjusted the ROI of the multi-year investment accordingly. Since the total ROI of the second investment was 40%, to obtain the average annual ROI, he applied the annualized ROI to yield 11.87% annualized. With this adjustment, it appears that although Joe's second investment is earned more profit, the first investment with an ROI of 20% for only 1 year was actually the more efficient choice. That's all everyone. I hope you learned something and thank you so much for listening. God bless.